Okay, let's unpack this. Welcome to the deep dive. Today, we're diving deep into a place that is, well, undeniably a titan in global finance, Luxembourg. We're not just talking about its famous fund industry, though. Specifically, we're looking at its strength as a premier hub for, traditional banking and finance deal making. We've got a report here that really pulls back the curtain on how it all works. Our mission in this deep dive: go beyond the headlines. We want to understand why Luxembourg consistently attracts these major international finance deals, the kind that shape economies. And crucially, we're going to zero in on the clever legal tools that are the unsung heroes, making complex cross-border transactions actually possible there. It's about getting to the real engine room, you see.
Yes, and the source material certainly confirms Luxembourg plays an outsized role. While many factors contribute, the legal framework is absolutely fundamental. It's the plumbing, if you like, that makes the whole system work, often quietly, but, well, powerfully. We'll really focus on the core legal elements that provide that crucial certainty and flexibility that global players demand.
So let's start with the sheer scale, because the numbers are pretty eye-popping. This report highlights that as of the end of 2024, Luxembourg was home to 115 international banks, hailing from 25 different countries. The sector's total balance sheet hit a massive 937.5 billion euros, and they pulled in a record 7.2 billion euros in net profit for the year. That's according to CSSF data. What really tells the story, though, is the international flavor. Over 92% of these banks are foreign-owned, many using Luxembourg as their crucial entry point into the EU market.
Right. And what's fascinating here is how that scale creates a positive feedback loop. It's not just the number of banks, it's the concentration of highly specialized expertise, diverse services, and deep pools of capital it attracts. The source points to key areas where Luxembourg is a world leader: corporate finance, private banking managing over 585 billion euros in that segment alone, and critical depository and custody services that underpin the investment fund industry there. And all of this rests on a foundation of stability, signaled powerfully by Luxembourg's AAA credit rating. That rating isn't just a number, it's a statement of confidence for capital markets.
Okay, so you've got this impressive structure, this critical mass. What's the secret sauce underneath it all? The report points to one specific law as the cornerstone piece and the true engine.
Exactly. That would be the Law of 5, August 2005, on financial collateral arrangements. Everyone just calls it the Collateral Law. It came from an EU directive, but Luxembourg implemented it in a way that, let's say, gave it maximum scope and minimum formality. Its primary objective is brilliantly simple: create a super robust, efficient, and, well, simple way to take security over financial assets. And financial assets is interpreted very broadly here: shares, bonds, loans, even money in bank accounts. It strips away a lot of the red tape you often find elsewhere.
And its defining feature, its superpower, as you put it.
That would absolutely be insolvency remoteness. Think of it as putting a virtually impenetrable force field around the secured assets. It means that even if the company or person providing the security goes bankrupt or enters any kind of restructuring or insolvency proceedings, the security interest you took under the collateral law remains valid. And critically, it's enforceable notwithstanding those proceedings. The assets are essentially carved out of the insolvency estate. They aren't typically frozen or subject to being clawed back later by an administrator like they might be in other jurisdictions. This provides a level of certainty for creditors that is, frankly, incredibly rare and highly valued in the global finance world.
Wow. And we saw just how committed Luxembourg is to defending that certainty in 2024. That was quite the moment, right?
It was indeed dramatic. In January 2024, there was a court appeal decision that raised concerns by suggesting this insolvency protection might only apply if the insolvency proceedings were within the European Economic Area. That potentially left non-EA creditors exposed. The market reacted instantly. You can feel the anxiety. But the Luxembourg government and parliament, they moved at lightning speed, passed a law explicitly clarifying that the collateral law's protections apply to insolvency proceedings anywhere in the world.
Really fast.
Exactly. And then, in December 2024, the Supreme Court issued a definitive ruling overturning that earlier Court of Appeal decision. What's fascinating here is the significance of those events. It wasn't just a technical legal cleanup. It was a high-stakes stress test that proved Luxembourg's absolute commitment to its legal framework and its promise of certainty. In an increasingly volatile global landscape, this kind of demonstrated resolve reinforces its position as a true safe harbor jurisdiction for high-value finance. Lenders know their security in Luxembourg stands firm, even if things go wrong elsewhere.
Okay, so you have this incredibly powerful foundation in the collateral law. How does that translate into the actual tools used in day-to-day deals, the things people actually sign?
Well, the main workhorse tool is the pledge agreement, or gauge. This is the standard way to take security over those movable financial assets we talked about. You have two main parties. The pledger, that's the entity giving the security, often a borrower or a holding company, and the pledgee, the entity receiving the security, typically a lender or maybe security agent acting for a group of lenders.
And the report mentions creating this pledge is simple, like unusually simple.
Astonishingly simple compared to many other places. All you need is a written agreement, usually a private deed. No need for a notary, no public registration required.
And why does this matter so much?
Well, it makes the process incredibly fast, discreet, and cost-effective. You avoid those hefty public registration fees sometimes based on the value of the deal that you'd encounter elsewhere. Speed and low cost, very attractive.
Simple to create, okay. But how do you make sure it's effective against the rest of the world, like other creditors who might come knocking? The report talks about perfection achieved through dispossession. How does that work depending on the asset?
Sounds a bit technical.
Perfection is key. It's like putting a public stamp on your security interest, telling everyone else you have a claim. Dispossession sounds complex, but it essentially means transferring a form of control or giving notice. The method changes based on the asset. For registered shares, like those in a Luxembourg Société à Responsabilité Limitée, SARL, or a Société Anonyme, SA, you perfect the pledge by recording it directly in the company's own internal share register.
So right in the company's own books. Exactly. It's like writing your name on the official ownership list held by the company itself. For bank accounts, it's a sort of two-step dance. First, formally notifying the bank holding the account, and second, which is absolutely crucial for priority, getting the bank to acknowledge the pledge and explicitly waive any rights they might have, like their right of set-off, using money in the account to pay other debts you owe them, or any prior pledge they might have had.
Got it. So the bank has to actively agree.
Precisely. For receivables, like money owed to the company from a loan, the pledge is technically perfected between the pledger and pledgee when the agreement is signed. But, and this is important, to make it effective against the actual person or company owing the money, the debtor, you must notify that debtor. Until then, the debtor could still validly pay the pledger.
So you have to tell the debtor. Makes sense.
Right. So market practice is always to send that formal notification.
Okay, so we've got the law, the tool, how it's created and made effective. Let's go inside the contract itself. What are the most critical clauses someone would see in one of these pledge agreements? The bits they argue over.
Yes. The report highlights several key ones. First, obviously the pledge clause itself. This is where the pledger explicitly grants the security interest, using language like pledges and grant the first-ranking security interest. Pretty standard stuff there. Then there's the secured obligations clause. This defines exactly what debts are covered, and it's usually incredibly broad, all present and future obligations, actual or contingent of whatsoever nature.
Wow, whatsoever nature. That sounds like it covers everything.
It does. It's the all monies approach. Covers the principal loan amount, interest, fees, costs, basically everything owed now or potentially in the future under the main financing documents, and the pledge itself. Very comprehensive protection for the lender. You also have representations and warranties. These are statements the pledger makes about the assets, like confirming they own them, they're free of other claims, they have the authority to pledge them. Lenders rely heavily on these.
And if they're wrong?
If they're untrue, it can trigger a default. Then covenants are the pledger's promises things they will do, or more often things they won't do, regarding the assets while the security is in place.
Like not selling them off.
Exactly. A critical one is the negative covenant preventing the pledger from selling the assets or putting other security on them without permission.
Okay. Now, the enforcement event clause is pointed out as particularly vital and heavily negotiated. Why is that one so important?
This is where the collateral law's contractual flexibility really shines. It doesn't just say you can enforce if someone, misses a payment. It says you can enforce upon an event of default or any other event whatsoever as contractually agreed. And a 2022 amendment explicitly codified that whatsoever, just confirming what everyone was doing anyway.
So whatsoever means basically anything you agree on.
Pretty much. This means you can negotiate triggers beyond just non-payment. Think breaching financial ratios in the main loan agreement, defaulting on some other debt that's a cross default, or even the mere start of insolvency or reorganization proceedings. Even those modern ones under the 2023 law we'll touch on. Or maybe even a material adverse change, a MAC clause, though those can be tricky.
So why is that power so crucial, being able to trigger it early?
It's an early warning system. It allows the lender to intervene and enforce their security before the situation deteriorates to outright payment default, potentially preserving more of the collateral's value. It's about proactive protection, not just reacting after the fact.
Right, getting ahead of the problem. And once that event is triggered, how does the actual enforcement happen? Does it involve courts?
Generally not, initially anyway.
Right.
Another key feature of the collateral law is that it allows for private enforcement mechanisms. You typically don't need a prior court order to start enforcing your pledge. The common methods are private sale, selling the assets in a commercially reasonable way, or appropriation, where the pledge takes direct ownership, usually based on an independent expert valuation. Or there's public auction, though that's less common now, usually conducted via a notary or bailiff. And the report mentions a recent clarification that's quite helpful. You can apply the proceeds from the enforcement even if you haven't formally accelerated the entire debt yet, demanded immediate repayment of everything. Adds another layer of flexibility for the secured creditor.
Interesting. And finally, the end of the line for the release clause. How does it end?
Pretty straightforward, usually. The security automatically terminates when all the secured obligations are fully and finally repaid. No more debt, no more security. The pledgee then cooperates to formally undo the perfection steps, for example, sending instructions to the company to remove the annotation from the share register, tidying everything up.
Okay. So the pledge over financial assets is clearly the star, built directly on that powerful collateral law. But what else is in the Luxembourg security toolkit for different types of assets? Not everything is shares or bank accounts.
True. The toolkit extends to other asset classes, but with different rules. For real estate, for example, you use a mortgage or hypothec. Crucially, this falls under the older civil code, not the collateral law, and that means different procedures. It requires a notarial deed and must be registered in the public mortgage registry.
A notary registration sounds more formal.
It is, and this triggers significant ad valorem fees calculated as a percentage of the secured amount. The report mentions 0.24% for inscription, 0.05% for registration. That can get very expensive on large deals, much more formal and costly than a pledge. There's also the pledge over a going concern, or gage de fonds de commerce, which covers a business's operational assets like inventory or equipment. This also requires registration. But here's a quirky detail the source points out. It has a severe restriction. It can only be granted to authorized credit institutions and breweries.
Breweries, serially?
Seriously, breweries. Not available to most alternative lenders, for instance. A strange historical quirk, perhaps. And the collateral law also allows for transfer of title for security, where legal title actually passes to the lender, but the pledge is generally much more common in practice.
Looking at the report's comparison table again, that cost difference between a share pledge low, basically just legal fees, and a mortgage with its high notary, plus those ad valorem registration fees, it's really striking.
It absolutely is. And this cost and formality difference profoundly influences how deals are structured. It's not just theoretical. For example, in real estate finance, lenders almost always prefer to take a pledge over the shares of the special purpose company that owns the property, using the efficient collateral law, rather than taking a direct mortgage over the property itself under the costly civil code.
Ah, so you turn the property into shares, legally speaking, for security purposes. Clever.
Exactly. It's a clever way to use the legal framework to transform security over an immovable asset, the property, into security over a movable one, the shares, just to make the deal more efficient and cheaper.
Okay, we've got the foundation law, the primary tool in the pledge, and the other security options. How do these tools actually come together in the real world of finance deals? Let's look at some of the themes the report discusses.
Sure. The report covers how these tools are applied across various sectors. In corporate M&A and private equity, for instance, you frequently see Luxembourg holding companies Luxcos, sometimes even double Luxcos used in the structure. Financing is often provided to these entities, and lenders take pledges over their shares, or perhaps the shares of the target company being acquired. This supports complex PE finance, allowing specific risks to be kind of ring-fenced within the structure. And the rise of alternative lenders, the non-bank lenders, has been particularly supported by this flexible security framework. They love the collateral law.
Makes sense. What about fund finance?
Fund finance is another major area. Subscription lines, where banks lend against investors' commitments to contribute capital, use pledges over those capital calls and related bank accounts. Then you have NAV facilities, which lend against the value of the fund's underlying portfolio. These use pledges over the fund's shares or interests in those portfolio companies. And here, that flexible whatsoever enforcement trigger in the pledge is vital. For any V lines, it enables enforcement based on, say, a breach of a loan-to-value covenant, not just waiting for a payment default when the value might have already dropped significantly.
Right, acting on value changes. What about distressed situations?
Distressed M&A and restructuring has evolved, especially with the new 2023 Insolvency Modernization Law. This law introduced more modern reorganization procedures, which is generally good for companies in distress, gives them breathing room. But here's the crucial balancing act highlighted by the source. The law explicitly states that the start of these new reorganization proceedings does not affect the enforceability of security granted under the collateral law.
So the pledge still holds strong.
Exactly. It's a dual-track system. The company might get breathing space to reorganize, maybe save itself, but the secured creditor's right to enforce their specific pledge remains intact if their trigger events occur. Even sustainable finance integrates these tools. The report mentions things like sustainability-linked loan features. Maybe your interest rate goes down if you hit certain ESG targets. And it points to Luxembourg's LGX platform, the world's leading platform for green bonds, as a key part of the ecosystem that attracts sustainable capital, often secured using these same pledge mechanisms.
Okay, very versatile.
Right.
Now, for anyone involved in putting these deals together, what about the practical side, negotiation, costs, timelines, the nuts and bolts?
Right, the transaction life cycle. Negotiation, naturally, involves the borrower, lenders, and their advisors, lawyers, accountants. Luxembourg has a deep pool of these experts. Key points beyond just the price or interest rate often include defining the covenants very carefully, the precise scope of the security assets, what exactly is included, and, as we discussed, hammering out the specific definition of those enforcement events. That can take time.
And the governing law. Which country's law applies?
That's a critical decision. The standard market practice is to use Luxembourg law for the security documents themselves, the pledges, the mortgages. Their validity and enforceability depend crucially on specific Luxembourg laws, especially the collateral law. You wouldn't want to risk using another law for the pledge itself. However, the main facility agreements, the underlying loan documents, they're very often governed by English or New York law. Those are the international standards for complex syndicated lending, with huge bodies of case law.
And Luxembourg courts are okay with that split?
Yes, absolutely. Luxembourg courts recognize and respect this choice of governing law for the underlying debt contract, even while applying Luxembourg law to the security created over Luxembourg assets.
Okay. Costs, we touched on this, but just to reiterate.
Yes, costs vary hugely based on the security type. Pledges under the collateral law are relatively low cost, primarily just legal fees for drafting and negotiation. Mortgages and going concern pledges, though, are significantly more expensive due to those mandatory notary fees and the ad valorem registration fees based on the amount secured. Beyond security costs, of course, you have the usual arrangement fees, commitment fees, administration fees for the lenders. And pricing is typically Euribor plus a margin. The report cites BCL data from February 2025 showing the average variable rate for new corporate loans over 1 million euros was around 3%.
And timelines. How long does it take to get these deals done?
It really differs based on the deal's complexity. Acquisition finance deals, funding a company purchase, are typically longer, often 1 to 2 years, sometimes more, involving extensive due diligence on the target company's operations, financials, everything. Fund finance subscription facilities, on the other hand, are usually much quicker, often just a few months after the fund's initial closing.
Why such a big difference?
Well, the credit risk assessment in fund finance relies heavily on the creditworthiness and diversification of the fund's investor base, typically large institutions. That assessment can be done much faster than trying to predict the future performance and risks of a single operating business being acquired.
Got it. The financial world never stands still, though. What regulatory changes are on the horizon that might impact deal-making in Luxembourg? What's coming down the pipeline?
The report highlights several key areas to watch. In digital finance, there's DOARA, the Digital Operational Resilience Act, that became applicable on January 17, 2025. It introduces comprehensive rules for managing ICT and cyber risks, outsourcing, adding a significant layer of compliance for financial entities. More work for them. Then there's MiCA, the Markets and Crypto Assets Regulation, effective December 30, 2024. This establishes the EU framework for crypto assets, with the CSSF, Luxembourg's regulator, acting as the national supervisor. Big changes there. And the Instant Payments Regulation, implemented in Luxembourg law in April 2025, mandates instant euro payments, 247 and no extra cost. That should speed up settlement, which is generally helpful for deals.
Okay, digital's big. What else?
Corporate mobility is also changing. An EU directive is being transposed via a bill expected in early 2025, Bill 8053, I think. This aims to harmonize cross-border company moves, like mergers or divisions across EU borders. But it also adds new protections for stakeholders, like minority shareholder cash exit rights and guarantees for creditors. It also introduces mandatory notary checks to prevent abuse or fraud in these cross-border moves.
So potentially more complex and time-consuming.
Yes, it could add complexity and potentially time, particularly for cross-border restructurings that involve companies migrating into or out of Luxembourg. More hoops to jump through. And finally, CSSF supervision itself is evolving. Circular 25870 extends a very detailed digital report, the revised long-form report, to all investment firms, starting with the 2024 financial year. This signals a move towards more granular, data-driven risk supervision. They want more data more often. And AML/CTF anti-money laundering compliance remains, as always, a top priority, with new legislation and mandatory questionnaires being rolled out.
Wow, that was a comprehensive tour through the engine room. It really underlines that Luxembourg's success as a deal-making hub isn't just about being in Europe or low taxes or anything simplistic. It's this powerful combination of its established scale, that deep expertise we talked about, and, as we've really focused on, that uniquely creditor-friendly, predictable legal framework. The collateral law and that versatile pledge agreement are absolutely central to enabling those diverse, high-value international deals.
Absolutely. And what's impressive, I think, is that while Luxembourg is adapting to significant global and EU-driven changes, digital finance, corporate restructuring, insolvency, modernization, the source material shows it's doing so pragmatically. The goal seems consistently to preserve that core legal certainty that attracts and retains international capital. That dual-track approach in the new insolvency law, allowing for reorganization, but explicitly protecting secured creditor rights under the collateral law, is a prime example of this delicate, ongoing balancing act.
So, for you, the listener, maybe consider this. In a world where financial markets can feel increasingly uncertain and complex, jurisdictions that proactively offer stability and, crucially, legal certainty become incredibly valuable safe harbors. Luxembourg has clearly built its reputation on this principle. As other countries grapple with modernizing their own legal frameworks, perhaps prompted by economic pressures or new technologies, how might they draw lessons from Luxembourg's approach? Particularly in that tricky balance between helping distressed companies and protecting the fundamental rights of secured creditors. Something to think about.